Hello and welcome to Market Views, a podcast series of Open Business Council and JPFS, where we discuss financial and trading news, interviews with key personalities, and engage with our audience. Now, today we have Edward Males, the CEO of Lekker Quant FX and their strategy Alpha Trade, and my co-host today, Peter Christensen from JPFS. So welcome, Edward, to Trademakers.
Good morning, guys.
So Edward, can you tell our viewers about the strategy behind Lekker Quant FX and what investors can expect if they invest in it?
Excellent. Lekker Quant FX is a fully automated, systematic FX strategy. We trade only liquid pairs, G10 currency pairs, and we trade during the working week. So we open trades on Sunday night, which is the open of Asia, and we close on Friday East Coast time at 3 p.m. So we never hold positions over a closed period. Our typical hold period for a trade is 24 to 36 hours. So we're not sending out thousands and thousands of trades a day. And we trade on a defined risk basis. So we talk about trading as a percentage of risk. So if I say later in the podcast, 1% risk, trading at 1% risk, that means that no more than 1% of the high water mark of any position is at risk in any one trade. If the trade goes against us and loses, it will take that 1% loss and it will move on to the next trade. There is no human intervention. We do not second guess our strategy in terms of downside loss protection, etc. That is all handled by the system. There is, however, eyes on the system 24 hours a day in case that there is an error. Typically, it will be on the other side from us. It wouldn't be an error on our side, but we always have eyes looking at our system. The system itself has been developed over a period of 12 years. There is just over $15 million of investment in our trading system, over 1 million lines of code. And as I say, the system currently trades FX, but then going forward will be extended into other non-FX products.
No, thank you very much for the introduction, Edward. So how long has the program been live and what has been the historical net results?
Program has been live now for 8 years. So we 8 years in a Jersey fund. It's actually been trading a little longer on a private basis, but we set up a Jersey Channel Islands fund 8 years ago. And that was really for shareholders to, as a window for the product being live in a real environment. And in that time period, we've also traded, a number of managed accounts. Historically, we have averaged just over 30%. On the upside, our maximum drawdown has been over 20, it's been equivalent, just over 20%, but that was in a year that we had 77% on the upside. So the way that we think about the world, or the way that I think about the world every year that I'm coming in, is I think about a 30% upside and a max 10% drawdown. That is typically our profile. Mm-hmm. We've only ever had one losing year, which is unfortunately last year. And then prior to that, I believe that we've only ever had 2 consecutive losing months. We typically don't have multiple periods of losing months. Mm-hmm. So again, we have a pattern which has some volatility in it, but that volatility is required to capture the upside.
So in terms of risk, I mean, you mentioned before a little bit about the risk in terms of the high watermark and your allocation to each transaction that you make. But as you've designed the system, what other dimensions of risk do you incorporate?
So risk is a function of the phrase I used was risk envelope. So risk really is a function of a number of things. So once you've considered the upside, the risk envelope are things like the number of trades. So if you have 1 million trades out there, you can be trading at a very small risk profile, but thousands of trades all going against you is obviously problematic. So we have a 0 to 5 trades a day is our trade profile. The hold period, again, is not holding over weekends. We also look for, we don't trade highly correlated pairs. So if we have pairs go through periods of correlation with each other. So if at a period one pair is highly correlated with another pair, you won't see two simultaneous trades going on. I think really the other thing is is our ability to optimize the return profile within the basket. So generically, I talk about 1% risk, but in actual fact, within that, there's an optimization of the pairs trading. So each pair may not be trading at 1% risk as those correlation coefficients sort of fall in and out of favor. Mm-hmm. So we might find that dollar yen, for example, has a very different trading profile than Aussie yen. Mm-hmm. That would be it. I think the other thing is we can constrain max net open positions. We don't do that within our platform or our fund, because we actually work on the premise that if the system is doing well, then you allow it to do more of what it's doing. However, we do run managed accounts where we have max net open positions, which is easy for us to constrain.
You talk about risk, you talk about correlation. Are you using the normal distribution in terms of risk, or using a skew distribution?
No, we consider risk to be a completely independent variable equation. So I don't consider the return series across the whole 10 pairs. I'm looking at the return series of one independent variable. The reason for that is each and every instrument trades as a completely independent entity. It has its own setup and what we call market structure, and then it trades within that profile. We do, as I say, overall look at the macro level of correlation over all of them, but each variable or each instrument trades completely distinct and independent of the others.
We monitor the trading all the time, every single day. We're looking at trading. Is there any discrepancy compared to the parameters that actually been told what's been offered to the investors? And we do this also for our own sake, because we are heavily invested as well into Lega Quant. So we do monitor this at all times, just to make sure that everything goes as being offered within inside the parameters of the risk. We don't look at so much on the performance in itself. We always look at, if it really goes wrong, how wrong can it go? And that's more important for me, but also for the investors to know that this is what we do on the side in JP Fund Services. And that's it.
Thank you for that, Peter. Now, if you mentioned earlier that you are in New Jersey, so can you tell us a little bit about the company behind Alpha Trade and where are you regulated?
Sure. Alpha Trade is legally domiciled in Jersey, Channel Islands. So we have a GP-LP structure in Jersey. Our GP holds all of our intellectual property, and that's a very important point. That entity, there is no third-party entity. I should have mentioned earlier on, by the way, Hilton, that there is zero third-party software in our system. It is 100%. That million lines, that's all us. So we have a GP-LP structure, and then we have a BVI entity, which is wholly owned by the GP. And that BVI entity licenses our Alpha Trade platform, and that's the platform that we use to engage with managed accounts, such as JP. The team itself is all domiciled in the US by a sort of quirk of history. Despite being English, I moved to the States 25 years ago for the donuts. I live in New Jersey. The remainder of there are 4 other people in the team, and they all live in Boca. So that's the makeup of the team.
So Peter, can you tell us a little bit about SGT as the custody partner for investments in the fund? And can you tell us what security do investors have that the money is safe?
Yeah, we use SGT as the custodian and the executing part. That's all that SGT is doing. That's, as mentioned before, is being monitored by the risk team in JP Fund Services that overlooks all the trading. Look at what's going on the accounts. And that's the two different parties. We got a controlling party and we got the execution and custodian party. Both with indemnity insurances and all that jingles and bells that's needed these days. For SGT, there is an external accountant control of all the books every single month. We don't need it. It's not, according to the regulators, that we have to have it, but we put that security in that we actually got external accountants coming in and check everything is correct and so forth. And we also, with the indemnity insurance, is very, very important, underwritten by Lloyd's. So we've taken as much precautions from the controlling part, JP in Switzerland, but also on SGT markets as the custodian.
And Peter, what are, in terms of the costs of somebody investing in the Alpha Trade FX strategy, can you tell us what the costs would be to the investor?
Everything is about the whole thing, the way that we actually done it. It's all about making sure that ordinary investors have the possibility to be managed like professional quant traders like Edward. Normally, you have to have $250,000 for actually getting in. Otherwise, it doesn't make sense for the managed accounts. We've done it in a bit different way. We have a setup by trade makers and SGT. It takes 3 to 4 minutes to actually open an account with SGT. And that's done, dusted. Fund the account. Say, I would like to participate, all the way down to $5,000. And there's no extra cost. This is the beauty of it. We don't have any custodian fees. We don't have any execution fees for going into a fund or into a program. There is a performance fee. I mean, it also has to make some money as well. There is a performance fee of 30%. Mm-hmm. If we also investors into the strategy. If we make money, it makes money. If it doesn't make money, have to go hungry to bed. That's just how it works. So there's no extra fees or anything. That's how we set it up.
So with all that wonderful structure that you put in place, the net return to the investor, can you just remind us what that is again?
The net returns actually has been this been a difficult year. 2023 has been really difficult. But over the period of time for Leka, I think we're talking around, is it just around 146% in total? Yes, there has been some drawdowns periods. This strategy is not for investors saying, I just want to go in for 1 month. No, you got to look at it for a year and take a look at that, or maybe 18 months. So if it's money that you need after 3 months, then don't do it. Mm-hmm. We look at things in the long run. So we've been in there more or less since we actually launched it on the platform. And we're going to stay in there for a long, long time, unless there is some things happening in the market where the system doesn't react according to the parameters. Mm-hmm. Different story. But this is a security for us, but it's also the security for the investor saying, we're in the same boat here.
Mm-hmm. So in terms of an asset class, which is quant, FX trading, how does that fit within a diversified portfolio of other assets and the potential the correlation of that with other types of investment strategies?
With a strategy like this, it fits really well into different diversified portfolio. It can be a multi-asset diversified portfolio or a fully FX diversified portfolio. Because it's a quant, and yes, there is some swing in the results, but the positive results always so far has been better than the negative results. The good thing about this strategy is because it's systematic, there's no human interactions, there's no feelings about this. That's why we actually like to have like a quant within inside our portfolio. And then the word's over to you, Ed.
Yeah, so the system itself, Hilton, was designed as a pure alpha-based system. Okay, so the strategy was designed not with positioning in mind. So that's important in as much as it sits within the global macro bucket and it sits within, quote, pure alpha. Now, as you consider it as part of a portfolio, if you take just being part of a currency portfolio, typically speaking, our style of trading will make us orthogonal to existing FX trades. So Peter may have already found this, and maybe he can comment on it, is we may be long a pair, a trade where he's looking at his system, he's actually already short that trade. So typically there's an orthogonality with existing FX strategies, because our strategy is completely a de novo strategy. It's built by us. The market theory was created by us. So there is nothing you can look at within our trading system and say, oh, that's a moving average, mean revert. There's nothing that looks like that. So that creates the orthogonality. As you consider it as part of a broader portfolio, in terms of having long short equity in there and other asset classes, well, typically we are uncorrelated to the S&P. So S&P has directionality in it, whereas FX, the thing that makes FX simultaneously interesting and very hard is it's non-directional alpha, and that's what makes it hard. Now, the fact that it is uncorrelated with the S&P, it's certainly uncorrelated with the FTSE, it's uncorrelated with other asset classes, means that as a portion of your overall portfolio, you are, quote, protecting the earnings profile when you're in periods of drawdown in the S&P, for example.
Thank you very much, Edward, for your introduction to Alpha Trade FX. It has been very, very interesting, and I look forward to following your performance.
Thanks very much
for having us, Hilton.
Lovely to meet you.
Follow us via jpfs.com and openbusinesscouncil.org, and please engage with us on these links below, as well as on LinkedIn and Twitter. And do send in questions for our next episode. So goodbye, and thanks for watching.